Alright guys, welcome to video 4 of module 1, and in this video we're going to build on the last 3 videos as we usually do. And in this video, before we jump into our next module, which is going to talk about how we're going to tie these major levels and market structure that we've learned into our technical analysis using our trend lines and our channels and some of our chart patterns to look for trade setups, we need to talk about how are we going to enter these trades once we locate them, okay, once we find these setups, because as I've mentioned in the past, and this is a very important concept for you guys, if you haven't heard me say it before, hear me say it now, that setups and entries are two completely different things, and we'll go over this in greater detail as we progress through this course. But realize that a setup is not an entry or a trade. Okay, a setup is just a pattern or a piece of technical analysis or some confluence that's coming together that's showing you that there is a trade possibility. But we then have to kind of go a little bit deeper down the rabbit hole. We have to zoom in and really wait like a sniper in the bushes for our candle patterns to really form, and we're going to be going over candlestick for reversal patterns and important candlesticks. We're going to go over the most important candlesticks that you need to be paying attention to in module 3. Okay, that's going to be completely all about candlesticks, but we need to spot our actual entry, and then that's when we decide to actually click the button and enter that trade, when we decide to actually pull the trigger on a trade. Up until then, it's all setups, but until we get that final confirmation, that's when we actually pull the trigger. Okay. Now, when we do pull the trigger, I want to go ahead and, like I said, cover this module. I want to go through this this video ahead of time so that we've already have it covered, and that you'll have it before we get to that point, that we've already covered that base. So what we're going to talk about today, we're going to talk about the 3 levels of entry, the 3 types of entry that we're going to always be referring to when we talk about taking a trade. And so I want you guys to learn this, really take it to heart, because we'll be referring to this from this point forward on every trade that we take. Okay, there's 3 different levels of entry, and we designate those by the level of risk that's associated with those types of entries. And it doesn't mean that you have to stick with one type. We will take all 3 of these types of trades at different points in our trading career for different reasons, but we just need to know the level of risk that we're taking when we do enter trades at these levels. Now, the first level is going to be the break or the bounce. So we have our levels of major support, resistance, our major levels of supply and demand, right? So as price comes towards those levels, the most aggressive way of trading these levels is to wait for price to get rejected, or bounce off of these levels, or to break through these levels or these zones. Now, once we see a candle that closes either through a level or a zone, or in the opposite direction at a level, then that's what we call either the breakthrough or the bounce. And that is our most aggressive type of an entry on the close of those candles, because it could be a false breakthrough. It could also be a false rejection, could be just a minor pullback. We don't know yet. We're jumping in a little bit ahead of the gun when we take these types of trades, and you'll have these trades as you go through your career, but just know that you're definitely jumping the gun if you're entering on these just on the break or the bounce of price. That's why we deem it as an aggressive entry. Okay, the next level of our entry is going to be the retest or the pullback. So anytime that we get a breakthrough of price or we get a rejection of price, we want to look for a little bit of a pullback from the market. That's going to be a big indication to us that we need to wait just a little bit longer. We need to be just slightly patient, because it can either be, like we said, it can either be the reversal of a fake breakout or a fake retest, and then the market's just going to continue going in the direction that it's going. And if that's the case, we want to wait for that to happen, because if we get in on that aggressive entry, that pullback can just take us right out of our position if it pulls back too far and just keeps on going in the direction that it was originally going. So we want to look for that. Now this is going to cause us to miss a lot of trades. So you're going to have to square with that up front, that having this very strict set of rules of being patient will cause you to miss trades, some that you would have lost and some that you would have won. We're going to see a lot of just straightaway trades that it breaks through or it rejects and then it just takes off like to the moon. And those are our woulda, coulda, shoulda trades, and we tend to agonize over those trades because we really wished we would have gotten in on those trades, because they we see all the money that we missed. But you have to keep in mind that those are the rare instances. Most of the time those trades will go against us, and in the end it'll cost us more money to do aggressive trading than it will to wait and be patient and look for the confirmation of these setups. Okay, this is one of those times, and I say this all the time. Again, if you haven't heard me say it before, hear me say it now, that sometimes you'll make more money not trading. And if you've never heard that said before, really sit and ponder on that for a day or two. Sometimes not trading is the best move. That's the way that you make money, because in the end, when you really start getting into becoming a professional trader, it becomes less of equity growth, and it becomes more of a job of capital protection. Okay, you're protecting the money that you've earned up to that point. When you start out with a $100 account and you really don't give a shit, you're looking to it's like going down to the racetracks. You don't care if you blow that money. But when you get to a point where trading is your income, your month, and you're dependent on making a certain amount of money every month, you can't take risks like that anymore. You have to become an agent of equity protection, and we'll talk about that more in the risk management. Okay, and our third level of entry is the continuation or the confirmed trade. Okay, this is the first candle that continues in the direction of our original bias, and it confirms that our trade setup is there. And then depending on the candlestick formations in the lower time frames or on the time frame that we're looking at, for instance, if we're looking at the H1 and we get a really nice bullish engulfing candle and we're looking to take a bullish trade, we're going to want to go ahead and enter that trade because it's confirmed that the trend is going in that direction. And now we can use, for instance, the level that was broken through or rejected at as our possible stop loss, or a little bit further down. And then we'll get into advanced entry techniques as far as judging RSI divergence, and we want to make sure we don't get stopped out by a quick stop hunt and things like that, because we're learning the retail trader way, but later we're going to learn how to avoid retail trader traps, where the market makers, they know that you're going to put your stop hunt level, not stop hunt, but your stop loss like 10 or 15 pips below where price was rejected at. They know that, and they'll look to spike the price really quickly to catch that stop loss before continuing on. And it's one of the most frustrating parts about Forex, because you will be right. Your trade setup, your bias, everything was correct, but you just got tapped out of your trade because your stop loss was where a retail trader would put their stop loss, and it got tapped, and then it went 50 pips in your favor, and then you can agonize about all of the pips that you lost on that trade, because yes, you should have taken that one to the bank. All right, so let's look at a couple examples, and then we'll take it to the charts. So we have our price level, and we have our two types of initial aggressive entries. The first type is, and let's say we have a demand zone, let's say price is in a bearish trend, right? And so the first is our breakthrough. That's when we have a candle close below that price level or below that demand zone, and it's broken through and closed, and we see that a new trend is possibly forming, a continuation of this bearish trend, and that it's not going to stop at this level, it's going to continue on. The second is when we get a rejection of price or our bounce. Okay, that's when price does stop at this level and reverses. And now we're looking for a new bullish trend to start because we're hoping that this support level it holds, okay, and that price doesn't go any further lower than that, and that we're getting in right at the beginning of this new trend. Either way, the close of this candle here or the close of this follow-up rejection candle here, those are aggressive entries because we have no confirmation yet that price will indeed continue downward or that that support level will indeed hold price from going any further down. Let's take a look at just a couple static examples. And again, we will go to the charts, but right now let's just look at the examples. So the first one is we have our breakthrough. Okay, price broke through this price level and closed below it. Right? Then for our bounce, we have price getting stopped on a dime. We have our little wick, but it doesn't close any lower than this price level. And then our follow-up candle, this is our aggressive candle because that's the first candle showing us that price is going to, or that this support level is going to hold price from going any further back, or at least closing any further back, further below that level of price. Okay, so those are our two aggressive entries. We have the close below or the first close above, signifying our bounce. Okay. Now our retest entry is going to be our second type of entry. It's going to be our conservative entry. Now this is where we get price on a bullish trend, on a bearish trend, once it's broken through that support level, that comes back and retests either that zone or that level and then gets rejected, confirming that that support is now resistance or that demand zone is now a supply zone. Okay, so price closes below either this zone or this level, confirming that it's now turned into a resistance level and does not go any further past. And then for our conservative entry, we have a retest of that support level like a double tap. This is going to give us like our double bottom setups or our W setups where we get confirmation that yes, it's not confirmed yet, but it's giving us a second tap, giving strength to that support level and that demand zone that price will not go any further beyond that. Okay, so that's our second type of entry. Less risk on that because we're getting a little more confirmation that we are on the right side of the trend bias, but we still don't have that bias completely confirmed, and that will be our third type of entry. So in our example, we have our breakthrough, and here it isn't always the next candle. It may take one candle, it may take 5 candles, it may take 10 candles, but we eventually get a retest of this level, which now confirms that this resistance or this support has now been turned into resistance, and it's looking to confirm that it's not a false breakout, that price will continue in that direction and that that resistance level is going to hold. Okay, then on our retest we have again price coming back down, retesting this support level. It doesn't always have to close on that level. It can be a wick tap. Wick taps are perfectly fine, but it's showing us that price, it has tested that level one more time and it has not closed below that level, and that that support level is holding. Okay, so that's our second type of entry, the retest, and that is a conservative entry, less risk than the aggressive, but still higher risk than our confirmed entry, which is going to be the continuation entry. Okay, this is our trend continuation. So we've had the retest of the level. Now we want to see one more candle close in the direction that we want price to go, so that it's confirming that that continuation of trend is valid. That's why we call it our continuation entry or our confirmed entry. And again, on the retest, this is going to be our other leg of our W. This is what's going to show us that that support level is going to hold. It's going to form the W formation, and usually the best ones are the ones that continue past this little neckline of the bounce and the retest. And on much larger time frames, that's where our entries are going to be when we look at like head and shoulders formations, double tops, double bottoms, triple tops, triple bottoms, things like that. We're going to look for the break of that neckline to look for our actual entry. So when we're looking at it on a much smaller time frame, when we're looking at it as just a candlestick pattern, we kind of want to look for that same thing happen with our follow-up candle. So in this example, okay, we get this continuation. This is our confirmed candle. It closes in the direction, and then we see this nice bearish engulfing form. So we've got kind of a Maribozu, not sorry, we've got a Harami pattern here, you know, the pregnant woman, and then we get our trend continues on downward, and we're going to want to enter and take that short trade. On the confirmation side or on the retest side of the house, we want to see that follow up bullish candle, and then that's our entry. We see we have W here, 1, 2, this wick is 3, and then this one, as you see, it breaks the neckline here of this W and continues on up, and then that's where we want to get in that trade. That's our confirmed entry, and that's going to be our highest probability entry. That's going to be the one that gives us the least amount of risk with the highest percentage of payout. Okay, so those are our 3 entries: the aggressive, the conservative, and the confirmed. So let's take a look at it on the charts real quick. I'll show you what I mean on a live chart, and then I'll let you guys get to your homework. All right, so let's take a look at this just in a very basic form on a chart. So here we have US dollar, Canadian dollar on the 1 hour time frame. So we have price coming down out of a range and retesting the support level. So here we have, with some really nice wicks to the low, some really nice pins pointing downward, a solid rejection at this support level. So we have price comes down, gets rejected here, and we have this this kind of doji formed. So we really didn't have much of a rejection just yet until we get this candle here, and that candle's what gives us our aggressive entry. Okay, so that would be our aggressive entry off of the rejection of this support level and this demand zone. So if you were to jump in there, it would be very high risk entry because we don't really have a retest yet or any indication that it's going to continue upward at this point, that the trend is going to reverse. And especially when we're talking about trend reversals, you really want to get confirmation that that support level or that resistance level is going to hold. So we have that. Price comes up, shoots up, not too bad actually. Right here you're probably thinking, I completely missed the trade. You know, you're like, why didn't I just jump in on the aggressive entry? I could be however many, let's do, I could be 50 pips in profit already. And that's okay, because not only does the retest of the levels give you more confirmation that these trades are going to play out for you, but they also give you a second chance at entering if you did miss that first entry. Okay, so we have price come up, then returns back down, and this is where we get our retest. Okay, we have a nice retest candle here, and this is what gives us our actual second opportunity at entry. And then this is going to be our conservative entry, the double bottom, the forming of the W here. This is going to, the rejection of price at this level is strengthening this support level and giving us more confirmation that this level is going to hold and that price will reverse and start heading upward. And then once we get this candle here, now it doesn't quite break the neckline like we had talked about, which would be here, but it does give us a nice, very solid Maribosu bullish candle, and this would be, where you would want to take your confirmed entry, and then from that point, price heads up and gets to about this point, consolidates for a while, and then it does eventually hit this next, this resistance level or this next zone that's above there. So if you would have followed the rules of entry, gotten in on this candle, then if you would have taken it up to the next zone, that would have been a nice 142 pip trade. And it would have been a lot less risk and a lot less headache if you would have taken this aggressive entry. You can also see that you would have had to sit through price falling back downward, and if you would have moved your stop loss up to break even, you would have actually lost that trade, because you would have then had to pay your broker commission and the spread. And if you had it like exactly at break even, you might have ended up, like I said, actually taking a loss. You might have broken just completely even, but more likely you would have taken a small loss on that. And just the disappointment of seeing price falling back down, this would have had to happen over a good 8 to 10 hours. And you don't want to put yourself through that. So wait until you get that retest and that confirmed candle, and you'll save yourself all the heartache, because this would have been just all profit. All profit. You could have scaled in another position here, possibly here, and then ridden it all the way up to that next level. Okay, so that's a good example of a rejection or a bounce, retest, and then our confirmed entry. Then if we look a little bit farther down, okay, here's a good example here. Okay, this is going to be our breakthrough. So we have price, it breaks through this support level and this demand zone, and this right here would have been our aggressive candle. Okay, you could have taken your entry once that closed below, or had broken through and closed below that support level. But we don't want to get in that quick. Okay, we don't want to get in that early. We want to wait for the retest, which, like I said, it doesn't always happen in the next candle. It can take 5 candles, it can take 10 candles, but this is where the patience part of it comes into play. And we eventually have price pulling back, and this is our retest candle here. And this is how I want you guys to label these in your homework. So this is our retest or our conservative entry. This level holds. It is now support confirmed into resistance. This is now support turned resistance. That has been confirmed by the retest of this level. It gets strength from that second test, and then this next candle right afterwards, this nice bearish candle, that's going to be our confirmed candle. Now it doesn't engulf the next candle, it doesn't always have to, but it is a very solid candle. This is forming almost a Harami pattern. I think this candle's a little bit too big, and we'll go into all the candlestick patterns later on in module 3, so don't worry about learning all of those just yet. But then we see from there we had price just drop all the way down to the floor. You could have taken this all the way down. We even had a little bit of a pullback where you could have scaled in a second entry right there. And we'll talk about scaling in and out of positions in a later module, but that could have been a second entry if you didn't want to enter on the first one. And then of course, as we get the break of this level here, you could have easily pulled then your stop loss up to break even and just rode that thing all the way down. Okay, and then again we get another breakthrough, retest, and price drops even further down. Okay, then goes into a little bit of a consolidation, but you already made your money, so no need to worry about all that. Okay, so that's just some easy examples on the charts, and I will be doing a couple markups like these and posting them in our Google Drive under a private or a small folder, a secondary folder labeled homework examples. And I know people have been having questions already about how the homework needs to look and how it needs to be turned in. And so I will make sure to post an example for every module of exactly what I want the homework to look like for you to turn it in. Okay, so I'll post an example of what I want these markups to look like. Speaking of which, homework that you're going to need to do for this, I want you to watch this video 5 times and really take to heart the 3 different types of entries that we've talked about, because we're going to be going over them much more in further modules, so make sure that you have that concept down. So I want you to do 10 charts total. I want you to mark up 5 charts showing a breakthrough of a major level or a zone. So now that we know that we have these major levels, show me price breaking through and retesting a zone and continuing on in a direction. So I want you to show me that. Then mark 5 charts showing a major level rejection. So I want to see that bounce with a retest and then basically a trend reversal. So breakthrough is going to be a trend continuation. The rejection or the bounce is going to be trend reversal, like our M's and our W's. And then I want you to highlight the 3 different candles that represent the 3 different types of entries, like we did in the chart markup there. I want you to label the aggressive candle, the conservative candle, and the confirmed candle for each of those different types of trades. All right, guys. Make sure you send me all of your homework in the Telegram channel. As you can see, each of these modules is just building on the next one. So in our next next video is going to be the beginning of module 2, and in that, now we're going to start bringing in our trend lines and our channels and our chart patterns into our trend, our overall technical analysis, and that's where we're going to find our highest probability of trades when we look for price to react to these channels, these trend lines, and within these patterns at major levels of support and resistance, these major levels of reaction, because that's going to be the key. We can find tons of examples of trend lines and we can find tons of channels and chart patterns, but finding the ones that react at major levels, that's where we're going to find high probability setups, and those are going to be your absolute best trade opportunities. And that's why I had you guys learn these levels first. Now we're going to apply them into chart patterns, and we're going to see some really beautiful trades start to open up and become available for you. And that's going to be that next step towards becoming a more consistent trader. When you take trades at these levels with these patterns of confluence, that's when you're going to start winning a better ratio of trades, a higher ratio of trades. All right, guys, until the next module, I will see you in the charts.